Hello and welcome to another episode of FinTech Focus TV with me, Toby Babb, and this one is powered by valantic FSA in our debate format. Wonderful to have you all here, and we have gathered for you today an absolute powerhouse of a panel talking about one of the most interesting areas of the last 12 months, I think in particular, which is the growing rise of fixed income ETFs. And it's an area which we've been seeing a lot of. We've got companies here who are right at the forefront of it. Absolutely delighted for valantic FSA to be powering today's conversation. So thank you very much to Peter. With no further ado, I'm going to introduce you to the panel. I'm going to ask them to give us a little bit of backstory to it. Really, really excited to be talking to this team today. And let's kick off with you, Mr. Peter Holmgren.
Hi, everybody. My name is Peter Holmgren. I joined valantic FSA, give or take 7 months ago. Tell you a little bit about valantic FSA. Valantic FSA is part of the Valantic Group. We are about 1,300 people in Europe. The FSA division is just above 300. We are headquarters out of Frankfurt. And Valantic Group is actually the fastest growing IT company within the DACH region. We are spread out for Germany, so we have several offices in Germany. We have subsidiaries here in London, where I am based. We also have offices in Madrid, Luxembourg, and Prague. We are very proud to have about 100 clients using our products for a variety of the financial services within Europe. So the valantic FSA introduce new adapted workflows that helps to bring a superior level of efficiency, insight, and business agility, allowing the financial industry to position themselves better for the future. We erase their technical depth by replacing them with hyper automated workflows, which allows them to reduce cost, empower better decision making, and make it easier for them to monetize data, automate and increase the value streams of the electronic fixed income trading business, or in short, future-proof their business.
Fantastic, Peter. It's a amazing story and one I've loved getting to know over the last couple of months, and it's really, really exciting. We'll come on to all of that shortly as well, because so much to talk about with what you're doing with that business at the moment. Let's go over now to Mr. Jon Butler.
Hi, I'm Jon Butler. I'm the CEO of Velox and co-founder. Velox is the only low-code cloud-based application platform built specifically for front office. We are using that to help capital markets participants modernize their legacy infrastructure, particularly for businesses and asset classes that work in the more complex arenas like ETFs, which we'll talk a little bit more about later. But thanks for having me. Good to be here.
Good to have you again. Nice to see you back again. Thank you very much. And now over to you, please, Bernie Thurston.
Okay, thank you very much. I'm Bernie Thurston. I'm the CEO and founder of ULTUMUS. ULTUMUS is designed and set up to aggregate and standardize ETF data on a global basis. I founded it 4 years ago, specifically because whilst working within the ETF industry, I realized that the ETF data was not represented correctly by a number of parties. And yes, ULTUMUS has grown quite substantially. We collate ETF data from providers on a global basis, and we're now the calculation agent to a number of ETF providers, again, globally.
Fantastic, and another great story of growth on a global basis. So congratulations for everything you're doing. My partner in crime, as always, in these things is Mr. Steve Grob. Steve, Vision57. Give us a little bit more about your background, if you would, sir.
Yeah. So Steve Grob, I'm the founder of Vision57. After I left Fidessa 18 months ago, I wanted to find what I thought would be the next generation of companies for capital markets. And I was lucky enough to come across Jon at Velox and separately the guys at valantic FSA. And through Velox met Bernie at ULTUMUS. And it's been really, really interesting just seeing how these companies sort of interconnect. And Toby, you remember we had a conversation, I think, when we were allowed to go to pubs. It was obviously quite a while ago, but talking about this type of an event where we bring together, technical experts in Jon, marketing experts and market structure experts. Together obviously with the the energy and excitement behind valantic FSA. So yeah, really looking forward to this one, Toby.
Fantastic. So as you say, look, we're there and we're looking at interesting subject areas, and speaking to Peter, that this is something which is at the forefront of that movement. Lots and lots of things to talk about with the rise and rise of fixed income ETFs. Going into it, let's begin with you, Bernie. Tell us a little bit about what's been behind the enthusiasm for ETFs at large at the moment.
And I think that's one of the most interesting parts, is the fact that the ETFs have been going since 1993. I was dragged into the ETF space in probably 15 to 20 years ago with the launch of the DBX trackers. That was my first introduction, and I keep thinking that then is going to be the year of the ETFs. And what's amazing for the ETFs is they keep on growing. In terms of, I think last year they hit $7 trillion worth of AUM on a global basis, and fixed income in that space again has hit about 1.3 to 1.4 trillion dollars of assets as well. And I think this is the whole idea, in terms of, as more and more people become aware of ETFs, we've seen it predominantly in the US, where effectively individual investors are buying ETFs on a more regular basis. It's slowly coming to Europe, where people are beginning to see the exposure that they can get, how easy these products are to access, and the transparency associated with them. We're seeing this on a regular basis in terms of, obviously, things like the Woodford funds, where effectively they started going down. People couldn't get access to the money, they couldn't redeem their assets. These are all the things where ETFs give people an edge, and especially within the fixed income space, whereas the bonds themselves may not be accessible to the bog standard investor. Yes, I've got fixed income ETFs in my own personal pension. I can see them pricing on a regular basis. All those things that are not visible to me within the normal bond space, I've got them within ETFs. And that's the part that I find very exciting, and I see it continuing more and more. I can't see where ETFs are going to stop at this moment in time.
I mean, I think the thing that I found most interesting, having sort of been on the sidelines, was watching ETFs grow from being essentially equity based and then move into all sorts of other asset classes. And I have to admit, I never quite thought it would work for fixed income because of the complexity and the number of bonds that there are. But there's now, I think, someone said about 500 fixed income ETFs in the US. And I'm just a question for you, Bernie. How does that actual creation redemption process work? I understand it with equities. I'm just intrigued as to how does that work in a fixed income ETF?
I was going to say, with the fixed income space, it is obviously more difficult, but going back down to your point in terms of the various providers, as it's just very interesting in terms of, obviously in Europe, Tabula IM launched. They're an ETF provider specifically focused on fixed income. They've got some very interesting products. Some of the products have got 3 different underlyings associated with them. So fixed income is becoming a very innovative space. And again, as you alluded to, the creation redemption process is a little interesting. Whereas in the equity space, obviously you've got, in terms of creation baskets et al., which are fairly well defined. You can create in cash. Obviously in the fixed income space, because of the liquidity associated with some of the underlying bonds, it is a lot more negotiated baskets. There are, by the way, yes, we'll take in these particular bonds, but we won't take in any more of these bonds to get the basket structure as a whole. But again, it is becoming more and more efficient in that place, as obviously the more and more the focus is on these things. ETFs are getting more and more interesting. Obviously, we've just seen the explosion in the Bitcoin ETFs in terms of 21 shares with the multiple crypto baskets and everything else. Again, this has become a very interesting space, and there's more and more of these products being now made available. I saw today Goldman Sachs is launching the crypto trading arm all over again. And this is what I find so fascinating about ETFs, is they are a wrapper that make all of these products readily accessible. Again, going back down to that point, as in, I don't go and buy Bitcoin. I do have a Bitcoin ETF in my pension.
It's amazing, isn't it? And you mentioned there about this sort of global aspect of everything that we're covering here, And from what you were saying, there's sort of a spread from the US where it probably took off initially and then moved over to Europe. Jon, you're sat out there in New York as we speak. Do you see a massive difference between the US and UK markets?
I think so. No, I really don't. I mean,
I'm going to disagree with you, Jon, a little bit. Not for the first time, but because one of the things is that the liquidity profile of ETFs in the US there's so much retail participation, whereas in Europe it feels like much more of the trading is institutional in size. But I don't know, Bernie, whether you could confirm that or
I would completely disagree with Jon as normal. So I think in terms of, yes, to my point of view, the part that's interesting about the US is effectively they have got so much more, the 401ks, the way that they can access their products and everything else through the various retail brokers. Europe is not there yet. Europe is still very much an OTC market. I think we will see now people have got the self-invested personal pensions and the like. Those products will start becoming more retail based. People keep talking about the RDR review in terms of proving asset managers are showing the best price for the clients, and for those type of things they're going to have to start using ETFs. It still seems to be that little way off, and to be honest, I think the European market in its own right is partially to blame, whereas in the US everybody knows things like the SPY, the diamonds, the Qs, the big ETFs that everyone puts into their portfolio. We have nothing similar. We have probably about 50-60 different versions of the Euro Stoxx 50. Again, the same with the Stoxx 600 version of ETFs. We need to have a consolidation and clarity in terms of these are the products that people need access to, and that includes fixed income, equity, and other asset classes as well.
I guess just to defend myself there, I was answering the question from a technology perspective. So I'm not the right person to talk on the trading aspects, but certainly from a technology perspective in terms of demand and complexity and how people are using the products, it's the same in both regions.
Absolutely.
So
there we go.
I'll give you that one there, Jon.
I was going to throw that back to you then to come out and do it. I don't like people being ganged up on, Jon.
That's fine. I'm used to it.
So speaking of the US and you know, particularly with that in mind, there's probably something worth looking at, which is the legacy of the whole Trump era that we still sit in, and the bans on Chinese companies, etc. that exist. What's the impact there?
I'll probably take this one. I've been working quite extensively on the OFAC 19359 executive order. Yeah, exactly. Trump in his waning days effectively banned 35 individual companies. That is both the equity and the underlying and the US listings of those products. The Department of Defense has added another 9 companies in, and we're seeing effectively, most specifically within ETFs, people are very much interested in terms of what the companies are holding, what they can't be holding, because obviously for any US participant, they were banned from the 11th of January from increasing their portfolio, and effectively they've got to have divested themselves of those stocks by I think it's the 15th of November. And you've seen that very quickly, and I've been noticing over the last couple of weeks the number of those banned stocks being held by ETFs, and the US issuers have been really taking a side to their holding of those products very quickly. Not saying I always support the approach, but in terms of a way of the US flexing its muscle, it's been very impressive and very well organized in terms of the companies getting out of those stocks that are associated with the Chinese military side.
And does that have an impact with the changing government, or is it does it remain on course?
I will obviously defer to any US participants in this stage, but to be honest, I don't see it changing in any way, shape or form. Nobody's going to come into the presidential office and want to be seen to be weak on those particular aspects. And honestly, I think the Department of Defense is likely to add more companies into that mixture, because obviously a lot of those companies are interconnected in a very large way.
Yeah, absolutely. Let's move the conversation to you, Peter, because I think Valantic has been supporting liquidity provision in both cash bonds and fixed income ETFs.
Yeah.
How do those two workflows commingle and exist together?
Well, to come back to what Bernie said, as long as it's in equity as an underlying, right, it's fairly straightforward to quote and to get prices. It is a central lit order book. You have a price, you know how to do it. But then you have a fundamental difference in the market structure when it comes to fixed income trading. Fixed income trading, which is RFQ-based, request-based. You don't have prices. And I think it's very interesting when you bring those two worlds together. And that's what we've been doing. We have both equity market making and fixed income market making as part of our trading infrastructure, and bringing those two worlds together. It was actually start combining you to get Bernie's cross-asset infrastructure, where you can start actually participating and making market in a cross-asset product, and that's the beauty behind the trading infrastructure, when you can start combining that together. I'm not saying that we're there yet, because we're still work in progress, but it's definitely something that the market is asking for, and something that we are providing to the market as it is today.
And what kind of demand are you seeing from, and I think you said you have around 100 customers already. So are you seeing demand for fixed income cash traders to trade fixed income ETFs, or for equities market makers to trade underlying cash bonds? I mean, which one leads the race?
Well, it's definitely the fixed income that seems to diversify themselves, right? To find alternative fixed income. By default, the bonds are very illiquid, and when they're illiquid, they need to find that, to digitize it, literally to find a virtual instrument for it, and ETF is what we're looking for there. So that's definitely where we see the driver coming from.
And Peter, sorry, from my side, it's always one of the things that's intrigued me in terms of the pricing on an intraday basis of the fixed income ETFs. It always seems to be more of an art rather than a science, in terms of people trying to come up with models to price illiquid instruments.
Yeah, in fact, I know that the valantic FSA guys are working quite hard with some partners who can model what the price should be of something that's highly illiquid. And I think that's quite a cool thing to be able to do. Whether they're right or not, I guess, is a different question, because when you've got no benchmark, it's kind of impossible to say whether you're right or wrong. But there's a lot of tech investment going into
we're using
not inventing, creating a price for something that doesn't have a price.
Yeah.
And I was going to say, this is one of the other things I'm beginning to see within the market as well, in terms of, for fixed income products especially, people are beginning to move away from the price necessarily, especially in the US, necessarily defined on the underlying benchmark, but is now moving more and more to an evaluated price within the market, and using that to strike the price of the products. And this is, again, I find it very interesting in terms of how these things are evolving over time, and trying to get a more accurate price associated with the underlyings.
Peter, you were about to respond there as well, and
no, Steve did answer the question, so I thought he did it perfectly. So I thought I didn't need it to step in there.
That's why you work so well together.
Now we're using quite a lot of technology to do that. Most of it is AI based, where we try to learn and evaluate. Of course, we utilize machine learning in several parts of the trading infrastructures today to evaluate, to get a fair price, and to set a fair price, and to calculate fair pricing. But we also use it, of course, when it comes to predict the outcome of requests and so on, to guide the traders. But it's used in several parts of the technology. So I won't go in there now, but I'll open that door, because that's a kind of worm that we can discuss for hours. But definitely a lot of technology is going in. Sorry, Steve.
I would quite like to open that door, because I actually asked Jon, because I think it was you, Pete, that said, the workflows for fixed income are predominantly RFQ, whereas the workflows for equities and ETFs, by definition, are about trading on a lit central limit order book. And I guess I was intrigued on, in the work that you've done, how do you manage to sort of square that? Are they separate? Are they commingled? And what's the technical challenges to the whole thing?
And sorry, Peter, gonna
open the door and sent you through it.
Yeah, and I was going to say I was going to come complicate it even further. Isn't it? One of the things that amazes me is obviously because equity ETFs are lit, we get the price, we get the number of shares outstanding, we know dividends, we know corporate actions associated with them. The part that always amazes me with fixed income products, we normally get the ICE in, we get the number of bonds, that's it. We get no coupon, we get no clean price, we get no dirty price. And this is, I think, the big challenge for the technical parties here in terms of you've got such a sparse appetite of data that's delivered to you. You then need effectively the new technical hardware to be able to deliver and combine all of this data and combine it with additional data points to come up with the pricing that I think Peter's alluding to.
So yes, Bernie, the question is to come in from the cleaner the data it is, the more data we have, of course, the easier it becomes. But as I said before, we are applying machine learning to try to actually predict as much data point as we can when predicting pricing. Once again, as I said before, the cleaner the data is, the better it is, of course.
Absolutely, and look, moving that as the sort of perfect conduit to you, Jon. As Steve mentioned, there's a number of technology challenges within trading at ETFs, and we've heard a little bit about it from there. Talk to us about the challenges you're seeing, and I love how much collaboration there is in the industry at the moment, and the work that you're doing with valantic FSA to sort of really move that further forward as well. Let's bring you into this conversation.
Sure. Yeah, I think Bernie, kind of answered a big part of it, right? Which is, I really think, yeah, I really think the big, when you look at ETFs generally and why they are harder from a technology perspective, whether we're in FIC or equities, a lot of it is because of data, right? There's a big data problem, and you have to get the data problem right. You have to solve the data problem to be able to do everything else. Which is why Bernie and ULTUMUS exist, right? Because firms need help in getting that data problem right. That data problem, as Bernie just said, I mean that's really the big difference when you move into FIC, right? That there's still a long way to go to get all of those data points together, And I think that the rest of it, when it comes to the services associated with ETF, like the middleware for doing create redeems, things of that nature, that's kind of the same, and that's kind of transferable across both FIC and equities. Plus, then the piece that you were talking about, Steve, the going from the kind of cash equity style of trading to the RFQ market making style of trading, actually is a pretty straightforward transition for ETFs, because in a lot of the ETFs, people are actually market making anyway. There's already, and that's why, a lot of the work that we're doing, another complexity of ETFs is it's not just like, you can't just use a Fidessa and off you go, because everybody has their own pricing structure, right? People want to be able to add their own trading signals when they're making markets. So that type of, it's already a more complicated infrastructure in cash equities, and that actually allows it to transition into fixed income pretty seamlessly. But yeah, the data problem, as Bernie laid out, I mean, that's the big difference. And I think that's, going to be.
On the same note, what about the sort of visualization problem? Because you've got an ETF that in one sense you want to look at as a discrete unit.
Yeah,
exactly. It's comprised of a whole bunch of different things. So you've got to be sort of telescoping in and out in terms of the zoom. And I wonder how you represent that to a user so that they can kind of make sense of it and manage the detail as well as managing the sort of macro view.
Yeah, I think that's the same problem in cash equities as it is in fixed income. I think, again, you hit on one of the challenges, the technological challenges of ETFs versus other products, because it's a single name. It's also a list. Not only is it a list, it's a list of multiple. It can be multiple asset classes within that list. It can be multi-region. it's a little bit of everything. It's more complex to risk manage. I think that it's one of those things that really pushes, will really benefit from a lot of the technological advances that we're involved in Velox, right? In terms of aggregating, analyzing data, right? Because it's being able to provide a lot more flexibility and a lot more richness in different ways to pivot and look at data is even more applicable and useful in the ETF space.
And you've been working with Pete's firm, Valantic FSA, on a couple of things. Is there anything that you can share on some of the work that you've been doing there? Is it all too secret to share right now?
I think that Valantic has been. Velox is all about the the sales and trading infrastructure of the future, right? So sales and trading, 100% in the cloud, 100% in a browser, but able to give the type of responsiveness and richness that you get with traditional local installed trading apps, wrapped in a kind of a low code application development platform, so you're able to change it a lot more effectively and be very, very nimble. Valantic has been is great because it's allowed us to apply the techniques that we know work in cash equities to the fixed income space. So we're able to put together, and we're already been out there in the market with it, a kind of fixed income trading platform, fully in the cloud, fully web-based, very, very modern UI look and feel. I think what's great for us is that really starts to, for Velox, that really starts to complete, it's always been a dream, right? That there's one, that you can have one trading system that goes across asset class. And then broadly speaking, that's cash equities and fixed income. And I think, with the work we're doing in Valantic, that's starting to become an even closer reality.
On that point, I've got to say, in terms of the whole idea about web enabled and low code right now, we're finding it, and obviously Jon's built some of my front ends for the ETF space. We're now finding during the COVID, where people are working from home, we're now getting traders set up effectively the next day just to be able to see all this type of stuff. And it does make a world of difference. And yeah, we're seeing a lot of ETF traders on a global basis moving around and being able to just go, right, I want a front end.
On that point, Bernie, I think that what I see happening is that's the sort of reaction, how we're all working from home and everything, has prompted some changes in ways of working, and accelerated change that was probably going to happen anyway. And so now, the work that firms like Pete and Jon are doing is becoming, it's not going to go back just because someone goes back to the office. We've sort of been catapulted into the future, which I think is really interesting, both from a technical point of view and a market structure point of view.
Yeah, I think that's an interesting sort of aspect you touch on there, Steve, isn't it? Because when you look at that and you say, right, okay, in the new world of working from home, and having seen swathes of people from the cities and then disperse and having traders in their homes, we're looking at a sort of rapid evolution of what's happening, and there will be a retrenchment back to offices in the not too distant future, albeit in this potentially more hybrid manner. But we'll see a sort of a normal, which I think would be closer to the old normal than the new normal coming pretty soon. Does this have an impact on everything we're looking at?
Yeah, well, I mean, I think just because I'm going back to an office doesn't mean I want to give up the really elegant HTML front end that I've been using for the past 6 months. I'm not going to say, oh yeah, I want to use this dull old 1980s style thing. And so, in some ways, next gen tech like Valantic and Velox and the work ULTUMUS has probably taken a boost from some of this stuff.
Exactly right.
Because it's been this really strong catalyst for change.
Yeah, I mean, I think that certainly in a lot of large corporations, keeping up with technological change and continuing to invest, and I'm talking from personal experience, continuing, even though everything seems to be working, continuing to pump, tens of millions of dollars into kind of the next iteration of technology is hard to do when there's so many other pressures and so many other things demanding money. And I think what was useful about COVID was it doesn't matter if you were in the C-suite on the management committee or whether you were a developer, you're all working from home. And so you all got to see the nimbleness and the flexibility that was provided by things that were web enabled and built in the cloud. And it was incredibly eye-opening. I mean, I've had people, a number of C-suite at large firms on LinkedIn pinging me directly and saying, and kind of making this point, right, which is that all of a sudden they've kind of realized why people have been trying to get investment in these types of technologies over the last 4 or 5 years, which is why you're seeing such a big, acceleration in these things. And that doesn't, what it is, it's created, it's this agility, right? So people now realize the agility that they have in those types of modern infrastructures, and that's absolutely applicable whether you're working in an office or whether you're working from home. Because it's that agility that people that have worked, certainly within capital markets, it's that agility that people just didn't think were possible because they just never had it. Changing anything was always just a train wreck, right? So now all of a sudden it's like I can do that. I mean, me and Bernie have had this epiphany many times on shared clients that we have where we can just change it and give them give clients things the next day.
I was going to say I don't think it's even up for debate. Like here we are, there's 5 of us on a Zoom call across country, and it's now perfectly normal. I don't believe that people will just be going back to the office as they once were. There's not a chance of me getting onto the train at 5 o'clock in the morning anymore. I value my freedom too much. Yes, I will do it going forward when I can, but it's not going to be a daily occurrence, I think. And we've all seen HSBC has said they're going to get rid of 40% of their office space. The way we're going to be working has got to encapsulate home working going forward, and it's only due to the modern technology, Zoom, Slack, and all this stuff that enables us to do it.
And in some of your client conversations, Pete, have you noticed this sort of shift and this sort of greater embracing of newer ways of doing things rather than just giving me some more of the old stuff?
Yes, definitely. Clients are looking at, or the conversations we're having, they're looking at the possibility to open up, inject data, and they're looking for a modular solution where they can pick and choose. Clients are looking for a framework of stable components where they can inject their API, as to say, or their knowledge into the infrastructure in a nimble and easy way, which is all about opening up a trading infrastructure with APIs. They've always been very locked down in many organizations. I've been in this industry for 20 years. They, as Jon said, right, they've always been locked down, and getting new technology, allowing us to adapt to the new types of workflows that organizations are looking at and have to juggle is definitely on everybody's mind going forward.
And just on that point, I saw some more research today in terms of they're expecting equities and fixed income to go higher this year because effectively companies have got more efficient. So I think that's the part that I would take out of it. It's not been, it has been forced on people, but ultimately this is a more efficient way of working as well, in terms of the fact that, I can have calls with Singapore, Hong Kong first thing in the morning, then with multiple banks during the day. I have more meetings with external parties these days than I could have actually physically fitted in previously.
Absolutely.
Yeah.
That efficiency is a fascinating sort of area because it happens across businesses such as everyone's on this screen through to the biggest companies in the world. It is a more efficient era, and when you think about half-hour transatlantic flights for a meeting, for a half-hour meeting, and then return the same day, as I know certain banks have done at various different stages. The mind boggles, really, doesn't it, from both a CSR perspective as well as much as it does an economic one. So there are efficiencies coming into this, and I think you point on it there about that then driving the market. Look, we are in a situation at the moment where we had this time last year a catastrophic impact onto the global financial markets. It's moved back incredibly quickly to see that regain strength in times that would not have been precedented. And I think many sort of observers would have expected a correction again at this sort of stage. And in terms of some of the conversations I've been having, that's expected again. But there isn't a precedent for this. There isn't a textbook of where this can go, and it could well be that that a correction doesn't come, and we're here and we're going to see an even stronger market come out and further financial reforms. So I think it's a good way of us actually sort of looking at this and looking at future trends both on a macroeconomic basis and in terms of tying it back into fixed income ETFs and the story around there. Let's have a little bit of a roundup and say actually what are we expecting? Let's crystal ball this a little bit and see where we're going. Peter, I'll start with you.
Well, my crystal ball is saying that the way that we deliver technology to banks and the financial industry has changed forever. It requires more nimble, flexible systems, APIs, and the ability to inject data into trading systems, and analyzing that data on the fly is there for the rest of the financial industry's time. I think the value of data and to monetize that data will grow even further. That's my prediction, and that with nimble and flexible systems.
And so what would the enterprise companies be saying about that? Because I think one of the most exciting parts of the last 2 years, particularly the last year, has been the power of this collaboration and as you say, nimble businesses, APIs, opening the market up. There is a lot of legacy system that's stifled innovation in the sector for a long time, and allowed the sort of behemoths of the industry to maintain that sort of that domination. That looks to be a lot more open at the moment. Is that something you'd agree with? Or
well, legacy system doesn't really mean that it's bad. It just means that it's driving a technology debt within firms, which is making it very hard and expensive to change. So the APIs will open up and drive that innovation by opening those systems up, and to be able to pull out the data and to centralize that data into a single source and to analyze it, and then to be able to pull that from multiple sources into one. That's exactly what we said. And once again, legacy doesn't mean it's bad. It means that we can change it and leverage it. Sorry, Steve?
Doesn't necessarily mean it's good either.
No, that is true. It doesn't mean that it's good, but it does contain a lot of good data. Many of those systems has vital data for.
There's a very important subtlety there, Steve, that you just kind of highlighted, right? So legacy doesn't necessarily mean so. The difference is you can have a legacy system, right? And is the impact of it preventing you from doing things like innovating? Yeah. Right. And I think what's happening right now is people are finding ways to put facades across their legacy, so they can replace it over time, but it's immediately not stopping them from innovating. You know what I mean?
That's I think kind of the point to answer your question, like in terms of looking a bit further forward. We've been forced in every aspect of our lives to innovate faster than we ever have, and particularly in trading, technology, everything else. And that pace of innovation starts to become what people expect. And that's why I think, in some ways, there's a combination of what Velox can do with what, the valantic FSA guys can do. That's why I think it's so exciting, because it really speaks to that. And, to answer your question directly, Toby, I think the days of these behemoths that, whether they're internal systems or third parties that try and do everything, are numbered, because people are going to say, I don't have to. It doesn't, this sort of, there is a better way. People are now seeing that there is a better way, rather than just accepting the old ways, which weren't much good. And that, I think, is really, really exciting.
That ties it. That's sorry, John, carry on.
Yeah, what I was going to say was, I think that periods of innovation doesn't do this, right? It does this, right? And I think it happened in capital markets probably between 2000 and 2005 through the kind of massive electronification, and 2001 and 9/11 was kind of played into that. There was this big shock. And I think we've just had the latest, and nothing happened, literally stagnation for 15 years. And we've just had the last big shock. So I think that we are, and what's happened in that time is capital markets has just lagged behind other industries in terms of just evolving to the next efficient the next efficient level of operating. And I think you're going to see just a massive shift over the next 2 or 3 years as that all starts to play out. And that will manifest in a lot of different ways, right? It'll mean that banks will stop doing as much technology themselves as they used to, because they really shouldn't, right? They should focus on being banks, what they're good at. That's what other industries have done. And the number of people doing manual jobs within banks will reduce as well, like it has in other industries. And that will be through the use of data and becoming more data driven, whether that's, data to kind of data that allows you to automate, right? And data that allows you to apply kind of new technologies to allow you to kind of automate and need less people to grow.
Yeah, and this is the sort of shape-shifting aspect of headcount and where that goes into it, from manual tasks, as you say, through to technology. I think there's a really interesting piece that you said there about the sort of the stagnation of the market from 2005 onwards, which is absolutely correct. And you look at it, as you say, where other industries, and I think particularly commerce and retail, shot forward at alarming speed. Even retail banking, when you look at it, changed the face because people's expectations changed, and probably because of these things and mobile phones and people's instant gratification and expectations of what they are allowed to have at the click of a button. That user experience became shot to the forefront, and I think it didn't necessarily need to do the same thing up until there was a seismic shock in the industry within the banking arena, the financial arena. And as those expectations changed, so too did the speed of innovation, and that's probably something which I absolutely agree with is going to be the nature of what we see at the moment. Bernie, talk to us about
just one thing to add on to that, right? So the other thing that's kind of the fuel of this is because over the last 20 years, the technology has actually been advancing incredibly quickly because of some of those other industries that you just mentioned. Absolutely. And so things like Zoom, it's almost like Zoom was invented, like last January, right? And video conferencing has been around for more than 10 years, right? Yeah. It's almost like cloud and the web are kind of new things. I mean, it's 20 odd years old. So what's fueling this is this kind of, people have realized we need to do it a different way, and then have realized all these tools are actually just waiting to be used, right? So the two things have come together, and you just see this massive advancement.
And I'm going to go slightly off track here. Yes, I agree with everything that you're saying, but going back to Toby's point, rather than a pure technical aspect, I think there's a cultural aspect as well, the user experience and everything else. I think what we're going to see is going to be a massive expansion in ETFs, both fixed income and equity, with the ESG alignment, the Paris alignment, and everything else. I think there's going to be much more focus and we've seen the beginning of this with the GameStop type of idea, whereby people are now realizing the influence that they can have. And that's the part that I think is going to change. I think we're going to see the existing ETF products are going to be changed, their focus. We're going to see a lot more ESG analysis being done, this Paris climate change, the whole idea of becoming carbon neutral by 2050. I think there's going to be a lot more pressure on politicians to do this. And now I think we've got the cultural momentum about people realizing about their quality of life and everything else is going to change people's financial focus associated with this as well.
Steve, let's turn to you here a little bit, and as we begin to wrap things up, talk to us about your thoughts for all of this, because this has been something you've been watching, and I think this sort of impartial observer ability that you have on all of this, and you're seeing three businesses here who've come together to really be able to add value to each other. Tell me about what you can see out in the future.
What's been incredibly interesting, just going right back to where we started, Toby, is what I set out to do with Vision 57 was put together a bunch of vaguely complementary firms that I liked and that I thought had really innovative tech. And what's been interesting is seeing the sort of connective threads between them start to emerge, and collaborations and partnerships. And I absolutely think that that's the future, that people aren't going to buy one great big monolithic system from one supplier. they're going to buy bits from different vendors and then use the, the API economy gets dragged into capital markets. So you can expect these things to work together. And the examples, of the work that Jon and Peter have done together is absolute testimony to that. And I just think, it almost feels to me like we've broken the shackles of the old way of doing things, and suddenly there's a really, really exciting future ahead.
No, I 100% agree with that, and I've been very privileged in my position to be speaking over the last year to hundreds and hundreds of people who have really sort of had the I guess the handbrake taken off in terms of being able to innovate and being able to add value and being able to solve problems that have been frustrating people for years, but now needing to be able to do it. And it's very, very encouraging to see how that happened. It's been very encouraging to see nimble, innovative, exciting technology companies double and triple in size in very difficult economic times. And that sort of, I've said this a fair few times on this show, that actually seeing finance as the good guys in all of this after 2008 has been a really, really positive thing. But see technology within finance probably being the thing that's allowed everything to, to move and innovate in the way it has been, to me, the real signpost of the future. And that remains really exciting. I would like to say a massive thank you to Peter and valantic FSA for being able to put this together, to Steve for putting it through, and for the absolutely, as always, wonderful contributions of both Jon and Bernie. So it's been an absolute pleasure. Thank you all for joining us and providing such great insight into what I think is one of the fascinating areas of what we've seen. There's a whole piece that we could talk about how this impacts into the Bitcoin. Maybe that's for another show, which is another thing that I've been talking about all year so far. So I thank you so much. There's massive value for it. We'll put the links to all the companies into this as we put it out there. But if you're watching and you want to find out more, I'm sure you can get in touch with any of our guests direct, and they will be of high value with any of your questions that you want to follow up with. But to valantic FSA, to everyone who's on the show tonight, and to all of you who are watching, thank you very much, and we'll see you soon on another episode of FinTech Focus TV. Thank you.